Thinking about investing in real estate? Not sure which strategy will bring the best return? One property gives you 5% ROI, another 13%, same location, same budget, completely different results. That is because lots of investors focus on property itself, while the smart investor focuses on the strategy. Are you the smart one? It doesn't matter if you want to earn money fast or prefer something more stable in the long run. This video will break down the top investment models. We will do it based on the example of a paradise island of Phuket, Thailand, an extremely popular investment destination. Real ROI examples, project insights, and tips to help you choose what works best for you. Welcome to our channel. I'm Artyom, a real estate investor and co-founder of Insight Estate, your trusted partner in smart, well-informed investment decisions. If you are like me and you are into data-driven investing, don't hesitate to hit the subscribe button. We share real numbers, real cases, and practical strategies every week. Before investing in real estate, it's important to understand that your rental strategy directly affects your returns. Even with the same budget, annual returns can vary between low single digit and 13, 14, even 15%. That difference isn't about luck, it's about how you structure your rental income. Here in Thailand, especially in tourist-driven regions like Phuket, we are looking at two main strategies. The first is short-term rentals. These are usually projects managed by hotel operators like Radisson, Marriott, or Wyndham. They have a license that lets owners legally rent out their units by the day. The second is long-term rentals. These projects usually don't have a hotel license, so legally owners or management company can only rent them out for a month or more, and it's illegal to rent out for a few days. Each model comes with its own risk profile, income potential, and level of involvement. Let's break them down side by side so you can choose the strategy that matches your goals, your lifestyle, and your expectations as an investor. Short-term rentals are extremely popular in Phuket, thanks to the region's strong year-round tourist demand. If you go with this model, you will usually invest in hotel-managed projects that are legally allowed to offer daily stay. In this segment, there are two main ways investors can earn income. The first option is the guaranteed income strategy. It's very simple. You get a fixed annual return, usually for 3 to 5 years. The return is calculated from the purchase price of your apartment and typically ranges from 5 to 8% annually. The main advantage here is predictability. It doesn't matter if the hotel is full or empty. Your income stays the same. This is a popular choice for investors who want stable returns without managing anything themselves. For example, we buy a $150,000 unit in a project like VIP Caron. Oh, I love this naming. Situated in an extremely popular tourist location, property with a guaranteed 7% return will bring in about $10,500 per year. The second option within short-term rentals is the rental pool model. In this case, your apartment becomes part of the hotel's rental system managed together with other units. So all units are grouped into rental pools based on characteristics like size, view, and layout. For example, all one-bedroom units are merged into a single pool, and when one of the rooms is generated rental income, it's shared across all owners in that pool on a proportional basis. It doesn't matter if your exact unit was rented or not. Income is divided based on your share of the pool. There are two types of income distribution here. One is based on net revenue, where all expenses are taken out first and then the profit is shared. The other is based on gross revenue, where you split the full income with the operator and they handle the running costs. The revenue split depends on the project, but most often the owner gets between 60 and 70% and the operator takes the rest. Depending on occupancy and season, this model on average can bring 5 to 12% per year. A good example is the project named the Zero Bank Town, where our projected rental ROI is about 7.6% annually. With the same investment amount of $150K USD, your income will be $11,400 a year, almost 9% higher than the guaranteed model brings. Before we move on to long-term rentals, just a reminder that with zero installment plans and ease of property ownership for foreigners, you might be the one owning such beautiful apartment. If you'd like a completely free personal consultation or a custom project selection, hit the link in the description below. If you prefer a more traditional approach, long-term rentals can provide steady cash flow, not dependent on daily tourist traffic. Here, we can consider two main strategies as well. The first option is the annual lease model. You either manage the property yourself or hire a property manager who finds a tenant for a 12-month contract. Once the lease is signed, you receive monthly payments. That gives you a stable income that isn't affected by low seasons. In some residential condos in Phuket, annual lease returns can go up to 12%, but the average is around 6.8%. For example, a 150,000 unit in a project like the base Cherntale could bring in about 10,200 per year. The second option here is high season rental strategy. It's when you rent out the property only during Phuket's peak tourist month, between November and March, often charging twice or even 3 times the usual rate. The goal is to concentrate your income during this period and have the freedom to use the apartment for yourself during the rest of the year. However, overall returns are usually lower, around 5.3% annually, or about just short of 8,000 USD per year with the same initial investment. Now, let's compare these models side by side, assuming a property budget of $150,000. The rental pool strategy currently delivers the highest average return, around 7.6%, which is roughly $11,400 per year. The guaranteed income model follows closely with about 7% or $10,500 per year. The annual lease model comes in just under that at 6.8%, while the high season rental strategy is the lowest with an average return of 5.3%. As you can see, the differences are substantial and they do matter, especially when we factor in risk, involvement, and how you plan to use your property personally. So which rental strategy should you choose? It depends on what kind of investor you are. If you want stable income with minimal effort and low risk, the guaranteed return model is likely the best fit. It's consistent, predictable, and doesn't require active management. Just keep in mind that most contracts are limited to 3 to 5 years and may include restrictions on using the apartment for yourself. If you're comfortable with market ups and downs, and want the highest potential return, the rental pool strategy might be a better fit. It pays off when the hotel performs well and doesn't require your involvement once everything is set up. If monthly cash flow is important and you prefer a more classic rental experience, the annual lease strategy offers a good balance between income and control. And finally, if you plan to live in the property part of the year but still want to earn during peak months, the high season rental approach gives you flexibility. Just keep in mind that average returns are lower. At Inside Estate, our goal is to help you make the smartest property investment decisions based on your personal goals, budget, and lifestyle. Whether you're just getting started or already own an investment property, we are here to guide you with honest, data-driven advice. If you'd like help choosing the right project, get in touch. I will leave a link in the description below. I'll guide you through the selection process and recommend the best options based on your investment strategy. And if you find this video useful, don't forget to subscribe, like, and leave a comment below. We'd love to hear your investment questions. Thanks for watching and see you in the next episode of Inside Estate. Hi guys, just a quick note. Everything in this video is based on our research and experience in real estate investing, but it's not financial advice. Every investment carries risk, so please make your own informed decisions or talk to a certified expert.